Hi everyone. Many thanks for joining our Academy Accounts Workshop Part 1 today. I'm Catherine Patel. I'm a partner with Buzzacott's charity and not-for-profit team. So today we're going to be looking at the requirements for Academy reporting in the Academy Trust's financial statements. So looking at both the narrative side of the reporting and also the presentation of the financial results. So specifically also looking at the requirements of the Academy's account direction for 21 to 22. It's a relatively stable year in terms of reporting, so not many changes coming through that are different to prior years. So just before we start, just turning to the agenda. So just in terms of housekeeping, so all of you are automatically on mute and your videos are off. If you want to raise a question during either of the presentations, if you use the Q&A function in Teams, which you should see at the right hand side of your screens, put a question in there and then we'll be monitoring those. We have got quite a lot to fit into today's hour-long session, so there might not be that much time for questions. If we haven't got time to respond to your question, we will do so after the session. After the session, we'll be circulating the slides together with responses to any questions as well. So do please ask as we're going through. So really, I'm going to give an introduction to the reporting framework and looking at the narrative reports, the annual report, and then Matt will cover the presentation of the financial statements and again picking up some of the requirements of the Academy's accounts direction within there. So let's turn to the overall introduction. So overall, in terms of reporting, if we just turn to the next slide. So really, how do and what are the rules sort of regulating Academy trusts in terms of the financial reporting? So as Academy trusts, your UK companies limited by guarantee, so registered with Companies House, filing your accounts at Companies House, and you're also exempt charities. So as a result, you have a number of different regulations that you must comply with in terms of your annual report and accounts. The first being the Companies Act, which actually isn't too onerous. Next, you have UK accounting standards. They're all set out in FRS 102. And then becoming more prescriptive over and above those two requirements is then the charity statement of recommended practice. So the charity SORP, so required to comply with the charity SORP and your accounts will disclose that fact. And then in addition, on top of that, you have the ESFA's additional reporting requirements, which are set out annually in the annual Academy's accounts direction. So if we've just had the release of the 21-22 Academy's accounts direction. So it's really that charity SORP and the ESFA accounts direction that is really driving the presentation of your accounts, and a lot of guidance given within both documents. So if we just turn to the next slide, specifically on some of the Academy side of things. So as I said, accounts direction 21-22 is issued earlier in the year, issued in March this year, covers the accounting periods, as you would expect, to the 31st of August 22. So that's bringing in all of the requirements of the accounting standards, the Companies Act and the charity SORP as well. But as you're aware, the ESFA adding to those requirements in terms of disclosures that need to be made, many of those linking with the Academy Trust handbook in terms of some of the transactions you may need to get ESFA approval for. The really good thing is that the accounts direction includes a model set of accounts, so known as the Coketown Academy template set of Academy Trust accounts, and that gives an awful lot of guidance in terms of the narrative reports and links to further guidance that you can find where certain areas are particularly relevant to your Academy Trust, and also gives the expected presentation of the financial results as well. As I said, only minor changes this year to the accounts direction, and Matt and I will be covering those as we go through. I think there's in fact only a couple of areas for the narrative side of things. In the last couple of years, while COVID was sort of really hitting Academy trusts, the ESFA also issued for a couple of years running a COVID-19 bulletin, and that gave further information in relation to the narrative around COVID that was expected to be included within your accounts, and also the presentation of some of the funding streams and spend against those within the notes to the accounts as well. They've not issued a new version this year, but they are saying continue to have reference to the bulletin from 2021 because obviously trusts are still seeing some of the impact of COVID during 21-22 and have still received some of the funding streams and are spending down some of those funding streams. So important you still have reference to that. Also reference within the accounts direction to numerous ESFA good practice guides around governance, regulation and reporting as well. So good to turn into those where you need a little bit more advice perhaps in terms of some of the areas within the accounts. So we'll now start to look at the narrative report. So overall, the sort of annual report that the trustees, the governors of the trust, certainly for governors for a single academy trust, you'd be talking about board members, the trustees, directors of a multi-academy trust. So what's their responsibility in terms of the narrative reports in the accounts? So there are numerous reports included within there. If we just turn on to the next slide. So the main reports that you're including to really set out what the Academy Trust has undertaken during the year, what it has achieved, how it's performed, its constitution, organisational structure. So that's the trustees report, and that's going to be the longest of the narrative reports within the accounts and must be updated and tailored year on year to really set out what the Academy Trust has been achieving in the year. You also have a statement around governance and internal control. So this picks up internal assurance, it picks up some of the governance review elements. So really, how has the trust been managed, governed during the year, looking at some of the subcommittees there, particularly around audit and finance as well. And then we have a few more statutory statements which are a little bit more prescriptive in format. So the statement on regularity, propriety and compliance, really the wording sets and pretty heavily prescribed there by the ESFA. Obviously, if you have issues to report within this statement, then you will be tailoring that presentation of the report. And then the statement of trustees' responsibilities, again, a very sort of statutory statement. You wouldn't really be expecting to update the wording within that sort of template format. And then you'll have your auditor's report. So for our audit clients, Buzzacott will have a financial statements audit report and also our regularity report as well, where we're giving a conclusion on the regularity side of things. One of the points the ESFA has fed back this year, specifically in terms of the accounts direction, is really a reminder to the sector that you should not be using the template text from the Coketown Academy unless really it's related to those statutory statements, the trustees' responsibilities, regularity and audit reports. For the trustees' report, for the governance statement, you must be tailoring that heavily and specifically to your academy trust. So don't be tempted to copy in too much detail the Coketown Academy accounts for those areas. So let's just go into these in a bit more detail and just have a look at really what these reports comprise. So there's a lot of detail in the Coketown Academy template accounts. There's a lot of links in there as well. So it gives you the sort of the background information as to why certain elements are required with further other guidance documents. So the first sort of page or two of the accounts, you're likely to see the reference and administrative details. So this is where you're listing the members of the trust, the trustees of the trust, senior management team and advisors, auditors, etc. as well within there. Just a note on the members and the trustees, that should be the list of members and trustees right up to the date of approval of the account. So it's the two bodies that are in post at the date of approval of the accounts, but you should also be recognising any appointments and resignations in the year as well within the listing, or at least within the body of the trustees report too. The next main section is structure, governance and management, and although heavily tailored to the trust itself, may not change significantly year on year, because this is really looking at that sort of constitutional structure of the trust, the organisational structure as well. Just a few specifics to bring out within this section. So you'll have your key management personnel defined within this section. So this is really the body that the trustees have delegated significant authority to, typically your senior management team, senior leadership team, as you would have listed within the reference and administrative details earlier on in the accounts. So you have to set, you have to set here and discuss here how you go about setting the remuneration for key management personnel, who's responsible for that, what are your processes for that senior management team pay. Trade union facility time came in 2 or 3 years ago, so this is where you have employees who are trade union representatives and spend some of their working time on trade union business, and there's a requirement to disclose the amount of time spent and the sort of the value of that time spent. In terms of the next couple of points, so engagement with employees, this is only required if you have over 250 employees in the year. So really a section here talking about how you go about that dialogue, building that relationship with employees, the engagement with them. And then the next section again came in a couple of years ago. This was a company requirement, and this is only for large companies, so trusts that are large as defined by the Companies Act. So the criteria there, 2 or more of the 3 criteria, so gross income over 36 million, total assets over 18 million and employees over 250. So if you meet 2 of those criteria, you're large and you need to report on the point around engagement with suppliers, customers and others in a business relationship with the trust. If you're below that threshold, you don't need to report on this. And then a point that's new this year is if you have subsidiaries, joint ventures, associates as a trust, then you must talk about the organisational structure with them and the relationship with those other entities. So making sure that you're meeting that requirement this year. The objectives and activities section is really the overarching aims, objects and aims of the Academy Trust, but also talking about specific objectives and activities that you set yourselves for the reporting period. And then really the real discussion about what's happened in the year, your achievements, falls under the section for the strategic report. So the achievements and performance section really here is drawing out what you've achieved, what you've potentially not achieved as well, maybe what hasn't gone quite so well. The accounts direction refers to performance indicators, so the use of data here, so pupil data, academic, Ofsted data maybe that you want to convey within your trustees report. And really also looking at sort of the how you go about promoting the success of the company, and again that is only if you're a large company, sort of that strategic element to it, but really what have you achieved overall as a trust during the year, reference to data where possible. You also within this section will have your going concern assessment, so a requirement that the trustees, directors of the trust are looking at the going concern assessment and confirming or not that the Academy Trust is a going concern, in that the trust can remain solvent for at least 12 months from the date of the approval of the account. So if you're approving your accounts in December this year, you're looking forward for those cash flows, that solvency and financial viability through to at least December 2023. So a statement here within the strategic report section. I mentioned the point there about, sorry, I got these in the wrong order, but how trustees have promoted the success of the company. Just to note, that is only if you're a large company under the definition we just discussed. The financial review I'll come on to in a second in a little bit more detail, because this was expanded in last year's accounts direction. But within the financial review section, you should be including reference here to the trust's reserves policy, your reserve statement, what level of operational reserves do you hold as a trust at year end, and do you have a target level against which you are monitoring those reserves? So potentially for multi-academy trusts, they will set a certain sort of percentage of GAG maybe that you want to hold at each school level as operational reserves, or at overarching trust level equally. You will also within here be required to include details about the principal risks facing the trust, and this doesn't mean just financial risks, the broader risks facing the trust. So this could be demographics and pupil numbers. It could be in the past, it's very much been COVID here, but also any financial risks as well. And to make sure you're reporting on these risks, and you're also talking about how you go about mitigating the risks as well as a trust, as obviously as best as you can. And there's a section required in here on fundraising also, in terms of if you do fundraise as a trust, how you go about doing that, and also just a statement if you don't go about fundraising activity, again a statement to say that too. You'll have a section on future plans. So what are you planning to do in future years? Absolutely the next financial year, but you may want to look ahead a little bit further, and in the context of the white paper, the schools bill, there may be things here that you want to draw out if there's future growth plans, or if you're a single academy trust and a sort of thinking about what you may do. Obviously not disclosing too much sensitive information within this section. And then we have the streamlined energy and carbon reporting, again something that came in a couple of years ago. So again, something that is relevant to large companies. So if you're a trust that's classified as a large company, you will have to make sure that you're reporting on the energy and carbon reporting, and there's a table within the accounts direction that you're required to include within your trustees report. So if we just move to the next slide, I've just set out on there a little bit more information really around the financial review section of the report. Many of the sort of finance directors, finance team members will be responsible for drafting this section. And it's really trying to convey to the readers of the accounts what's happened in terms of the finances in a sort of lay terms. So for a non-accountant, would they understand what you're saying here? What's your underlying operational result, surplus or deficit for the year? The accounts are particularly complicated and distorted in some ways in how they're reported with pensions and fixed assets. So actually the sort of the true underlying educational operations, what's happened here financially. Obviously, if there have been any significant events in the year that have affected financial performance, then you must report on those. I mentioned the principal risks and uncertainties that you need to include here, and also anything that may impact on the trust's finances going forward as well. So reference to that if you are concerned maybe about the demographics in your local area, and that certain schools may be struggling for a period of time. And then if there is anything really that's that happens before the sort of or well at the reporting date, anything that's affecting the financial position of the trust, so particularly here the operational reserves, your balance sheet figures, again you would be expected to explain all of this within the report, particularly anything that's material. So really, as I mentioned, just in terms of those final 3 bullet points there, so key factors underlying that trust, the trust's operational result in terms of the financial position, the key sources of funding, so if you've received any exceptional funding in the year, and how you're driving the use of that funding to impact the pupils and hit the key objectives of the trust. And as I mentioned, the trust's fundraising practices also have to be disclosed within this section, within the accounts. There are just on the next slide, and I won't go through this in any detail, but there are, if you do have a notice to improve around finance, then your financial review must be covering this as well, to really talk through what you could be doing, or what you are doing, what you should be doing in order to ensure that that notice to improve is lifted. Hopefully not applicable to many of you. So if we just then move to the next slide, these were some of the points that came through in previous bulletins around COVID-19. So when we're looking at this from the context of the narrative within the accounts, really what impact has COVID had on the organisation and through 21-22, what impact does it continue to have? Has it resulted in additional funding? We're seeing a lot of trusts at the moment that have got some supplementary funding coming through and actually have saved costs in some areas, not on purpose, but because of staffing vacancies and the difficulty in recruiting staff, potentially retaining staff at the current point in time. And that's sort of the longer term impacts of COVID. And obviously that goes into the future as well in terms of what will that mean, particularly sort of future years as well, with increasing inflation on costs as well. But looking at COVID in the round, so impact on what you've been able to achieve in the year, the sort of the post-COVID recovery as well, what you've been doing to try to really make sure that the impacts of COVID are minimised as much as possible going forward, and anything particularly on the finance and risk side as well. Just one final point to mention there is within the governance statement rather than the trustees report, and that's the last bullet point. So if COVID has meant that you've continued to have an impact on your governance, on your internal control measures, then that should be reflected within your governance and internal control statement. So that would you'd be really reporting that within the second statement rather than the trustees report, which I think is where we go on to now in terms of the next main statement. So the governance statement is in a more prescribed format, but you must tailor this to your trust. And this is really looking at the governance arrangements within the trust, so around the board themselves, but also around delegation to subcommittees. It requires discussion around governance review. So how have you reviewed governance in the year? When did you last do a governance review? What were the findings? How do you assess the effectiveness of governance within the trust? And the SFA have reported back that this is often missing from trusts accounts. So just really a specific mention there that the governance review element, the effectiveness of governance, must be reported upon within your governance statement within the accounts. Information needed here from the clerk, potentially director of governance, head of governance, around meeting attendance, the board members who've served during the year, and you have to include statistics around meeting attendance for the boards and the relevant subcommittees as well. How you go about reviewing governance arrangements, and also for this year they've added in a point here about noting how conflicts of interest within the trust are managed. So obviously an area that the SFA are really keen upon through the reporting mechanisms to them. They want your governance statement now to cover how you're managing conflicts of interest. So for example, that you have a register of interests, how you then convey the detail on that register of interest to others where relevant, and how that really affects your procedures within the trust. So how are you going about managing potential conflicts and conflicts? As I mentioned, subcommittees, so particularly here, committees that relate to finance and audit should be mentioned here, and again with meeting attendance. You'll have a statement on value for money, so what steps have you taken in year for the trust through procurement processes, potentially specific tenders? How have you gone about it, really achieving value for money as a trust? And then the internal control side of this is also reported in here, so linking it to risk as well. So how effective has the internal control and risk framework been in the year? How has it operated? And what have you done as a board to be able to check that? And trust therefore will use internal scrutiny, internal assurance in a number of different ways that are prescribed by the handbook. You have to say within the governance statement how you go about seeking that internal assurance. Is it peer review, an external reviewer? so that you can really assess whether those internal controls are operating effectively or not. You need to report in here how you go about internal assurance and also the findings on a very summary level, but the areas covered and any material findings from the year in question as well. Again, the ESFA reported back that some of the reporting around internal assurance is sometimes a little light. They have expanded that over recent years, so do look at the reporting requirements around that. And again, as I mentioned, COVID-19, if there has been a continuing impact in 21-22, then do report that within here as well. So I mentioned a couple of the areas there that the ESFA have reported back are potentially incomplete in reporting, the governance reviews and the internal assurance, so ensure you cover those. The other point that is often missed is the point around the board meetings and the number of board meetings. So you have to have at least 3 board meetings per year. If you have between 3 and 6 board meetings, so less than 6 board meetings per year, then you have to report on how the board ensures effective oversight of the trust, despite you not meeting 6 or more times in the year. So again, just a reminder there that you should include that. If you only had 3, 4 or 5 board meetings in the year, then you need to be reporting it and addressing that point. So just going on to the next slide. So this is really just the final slide on my section on the narrative reports. And as I said at the outset, this is really very much in a prescribed format set by the ESFA. So this is looking at the regularity and propriety and compliance, particularly around government funding. So regularity is checking that the money you're spending, the government funding you're spending is being spent in line with the terms setting, the terms set out by government, and that it's proper as well, so it's not fraudulent there particularly. So assuming there are no issues on this, then you follow the prescribed statement set by the ESFA in the Coketown Academy model accounts. If there is any irregularity or impropriety that needs to be reported, then this is where you would be addressing it. One way in which to do that is to expand upon that issue within the governance and internal control statement, and in the regularity statement is just to cross-refer back to the governance statement. It just enables the fuller discussion to happen around governance and internal control and risk all in one place. And then your regularity statement is referring back to that. Equally, you can report on the issue within your regularity statement as well, and that's signed off by the accounting officer. So must be reported here. It would also be picked up by the auditors in their regularity assurance report as well. So I'm going to conclude there, and I will now hand over to Matt, who will cover some of the financial statements presentation. Thank you.
Thanks, Kath. So for the next 20 minutes or so, we're just going to be going through the second part of the model account. So this is really focusing on some of those key disclosures in the accounts, as well as some of the changes to the direction this year. So as Kath mentioned, there's been relatively few changes to the reporting requirements this year. So within these slides that are coming up, the key changes have been marked with an asterisk to highlight those which are new requirements this year. So just turning to the first slide that we've got. So this is on the statement of financial activities, or the SOFA, and this is page 30 of the model accounts that you've got. So on some of these slides, we've got snips on the right hand side of the slide showing snips from the model accounts, but in some of them the detail may be in the underlying document. So if there's anything which isn't on screen, it will be in that underlying document, and where possible we'll give page references to that as well. So in terms of what this SOFA shows, so this shows the movement in the trust's funds during the year. So taking on in terms of the lines from the top down, to the first subtotal of the SOFA is the income of the trust in the year. From that following line down to the next subtotal is the expenditure. And then there's 2 further lines which contribute to the overall movement in the funds in the year, and those relate to any transfers between funds in the year, as well as any gains and losses relating to the pension scheme movements. So really, in terms of the SOFA, there's 3 points which I just really wanted to draw out on that. So firstly, just a reminder about those different funds that we've got. So these are represented by the different columns on the SOFA. So the first of those is the unrestricted funds. So those are any funds which can be used for any purpose aligned to your constitution, really, as an academy trust. So most of these funds will be amounts that are generated from ancillary activities. So any catering sales, for example, hire facilities, that kind of thing, that will go in your unrestricted funds column, along with any costs associated with the generation of that revenue. The next column along is the restricted general funds. So these are any funds received for specific purposes other than capital grants. So this includes those government grants such as GAG, pupil premium, catch-up premium, those kind of things where there's specific conditions attached to the funding. So for academies, the vast majority of your income and costs relating to the day-to-day educational activities will pass through this fund and this column of your SOFA. And then the third and final column is your restricted fixed asset funds. So these are funds which are received specifically for the use of capital purposes. And this is probably the fund which tends to require the most consideration and the most thought when preparing your accounts. So in terms of the income to this fund, so this is primarily the ESFA capital funding that's available to academy trusts. So for all trusts, this will be your devolved formula capital income. And then for single academies, this might also include, for example, the value of any approved SIF bids, which have been recorded as income here. And for multi-academy trusts which are eligible, so those which have got 5 or more schools and 3,000 pupils, any school condition allowance or SEA funding, which is recognised as income in the year, will also be shown as income to the restricted fixed asset fund. And in terms of what's shown as expenditure in this fund, so the expenditure to this fund will be your annual depreciation charge. And then in some instances as well, you might have charged some repairs or maintenance, repairs and maintenance costs against school conditional allowance or DFC funding. And in that case, that would also show as expenditure through your fixed asset fund. Now, there's two probable scenarios with respect to this fund which should be considered when preparing the accounts at year end. So the first scenario is when you've received capital funding for specific projects. So you might have got a SIF bid that's restricted to specific window replacement, or you might also have a program of projects which you want to come from a specific pot. So you might want your SEA funding to go to a specific program of works. So you should consider when you're preparing your accounts whether the extent to which that was fully utilised at year end, or the extent to which the works were still ongoing at the year end. So if there's unspent funds in relation to these restricted areas, the year end value of your capital fund will end up actually being in excess of your year end value of fixed assets by the amount which is unspent at the year end. So that's one of the two scenarios. And then the second scenario is when the value of your capital works in year exceed the value of your available capital funding when you've taken into account any brought forward unspent balances alongside any required carried forward unspent balances, as well as your income for the year. So when this is the case, a transfer, and that's the case here on this example here from Coketown, when that's the case, a transfer is shown out of either unrestricted or restricted general funds into your capital funds, and that represents the required revenue contribution to those capital purchases in year. So the next point to mention in terms of SOFA, which tends to relate to more complex transactions, and this won't necessarily relate to every school or every trust, but it does relate to quite a few these days, and that line is the transfers in from local authority on conversion. So when a school joins a trust, there's really three primary components which gets reflected in that line. So the first of these is the value of fixed assets which get transferred. So the value of these fixed assets will be transferred and shown as income to the fixed asset fund. And if you school joining, it's important you understand the basis of the valuation of those fixed assets and any fair value adjustments you might require on transfer. So for local authority transfers, typically this value is required to be obtained by an independent valuation of the property at the date of transfer. And for existing academies, there may be sufficient records existing within the academy trust which document a previous basis for valuation. So when recognising this transfer, it's important to make sure accounting treatment of any property is in line with your existing accounting policy. So for example, if you as a trust already don't value land, you'd want to exclude that from the value transferred if the previous trust did value land. So just really aligning your policies and that kind of thing on that transfer. The second element which comes over from those schools are any budget surpluses on conversion. So most commonly, that's equal to the net current assets of the incoming school. So this will be any cash that they brought over, as well as any receivables at transfer date, less any accrued payments that they had outstanding as liabilities when they come over to the trust. And if that transfer is coming from a local authority, those funds will take the form of unrestricted funds. And then the third and sort of final element, which also gets transferred over, is the net deficits on the local government pension scheme. So this is actually shown as net negative income to that restricted general fund on transfer. So they're the key points on the SOFA, but one final point I just wanted to mention on this slide was around how your statutory financial statements reconcile to your management accounts. So because of the slightly different basis of reporting, it's important to understand the reasons why the differences arise between period 12 management accounts and the final financial statement. So being able to reconcile the two gives sort of your board members that comfort that the financial statements are consistent with those accounting records that they've had access to and that they've been presented with throughout the year. So really, to enable that reconciliation to be performed, I'd recommend taking a snapshot almost of the trial balance, which the management accounts are based on, so that those final year-end adjustments can be tracked against that trial balance, so that reconciliation of the movement, which will differ from trust to trust, can be provided to the board members. Being able to track those changes can really help with that year-end approval process and ensuring a smooth sign-off of the accounts. So moving on to the next slide here, we see the balance sheet, and this is page 31 of the model account. So at the bottom of the balance sheet here, we see the overall funds of the trust. So that's split in a bit more detail than we saw on the SOFA. So the main fund which we see here, which wasn't on the SOFA, is the pension reserve. And having this shown separately helps us to identify those revenue or operational reserves of the trust more clearly. And these are the funds which typically thought of as being available to the trust for discretionary use in future accounting periods for the benefit of pupils, or to be retained by the trust in line with their reserves policy to help mitigate any against potential future risks that might be on the horizon. So those operational reserves are defined as the total of the restricted income fund. So in this case, the 464,000 plus the total of the unrestricted fund. So in this case, that would be the 278,000. So in this instance, for Coketown Academy Trust, the operational reserves of the trust would be a total of 742,000. Now, the most recent benchmarking from the ESFA suggests that on average, trusts are holding approximately 2 months worth of payroll in reserves at the moment, but this does vary slightly across the sector, and there's not necessarily a hard and fast rule with respect to reserves policy. But as a general rule, we do tend to see sort of larger MATs holding a smaller proportion of their expenditure in reserves compared to single academies. Moving now just to talk about the pension reserve a bit. So for most academy trusts, the largest single liability on the balance sheet will be the net liability of the local government pension scheme. Now this is the reserves, having this as a separate reserve sets aside a separate pot to match this liability and prevents distortion of your reserves because there's this large liability on your balance sheet. So in this case, the pension reserve of a negative 1413 ties into the defined benefit pension scheme liability, which is around 2/3 of the way down the page. So we sometimes do get asked the question by concerned trustees as to whether or not the trust will need to pay this liability back in one fell swoop, and if so, when this was likely to take place, and whether this means there's a potential insolvency risk to the trust. Well, this figure that we see here on the balance sheet, and this is a real simplification, but it's the additional amount the trust would have to pay effectively into the scheme in order for all their current and previous employees to stop work at today's date and take their total expected retirement benefit today. So there's not really a risk to the trust in the sense that the liability would all materialise in one fell swoop. And this liability is one that the scheme actually will seek to recover over time. And that will be through a combination of the contributions that employers and employees make, as well as the actual investment strategy of the trust on those assets that they already hold. So the risk, therefore, for trusts with respect to this pension scheme is in the potential increases that you might see in the rate of required employer contributions to the scheme. And now that's set by the fund administrators, which is based on actuarial valuations, which are performed every 3 years in full. The next triennial valuations of those LGPS schemes are taking place generally at the moment in respect to the fund positions at 31st of March 2022. And changes in contributions are likely to be implemented from 1st of April 2023. So that's where the potential short-term risk sits for trusts in relation to any changes in these rates. So one potential indicator of any change in rates would be the movement in the pension scheme net liability since the last triennial revaluation, because that can give an indication of the change in the funding position of the scheme since the last date. However, there's no necessary guarantee that a movement in net liability will always be mirrored in the contribution rate. So each scheme also has what's known as a funding strategy statement, which is unique to each fund, and changes in that strategy can also impact the changes in the potential contribution rate. So for that reason, funds in different local authorities with similar net deficits can end up paying at different rates of contribution. So also on funds, we mentioned on the last slide fixed asset funds. So again, just to mention differences between the fixed asset fund here and the value of the fixed assets represent any unspent capital grants which form part of the current assets for the trust at the year-end date. So just moving now on to the next slide, which is on accounting policies. So looking through your accounting policies, which come after the cash flow in the account. So you should be looking to make sure all your key policies and all your policies are consistent with your accounting framework and also consistent with the way that you're accounting for things. So there's two really that we're paying at the moment particular close interest to as auditors, because they relate directly to very specific auditing standards. So these are the policies with respect to the key accounting estimates and also to going concern. So accounting estimates generally will remain relatively consistent within an Academy trust year on year. So it's just a good practice to check that the policy includes all your key estimates. So we'd expect all trusts to have material estimates in relation to depreciation rates that they use in relation to fixed assets, and also those assumptions used in the actuarial valuation of the local government pension scheme with respect to things like forecast inflation rates, forecast life expectancies for members, that kind of thing, which all underpin that valuation. But also depending on top of these estimates, depending on the specific activities of your trust, there may be additional or new estimates that you might have arisen in year which needs to be recorded here. So for example, it might include any material provision for clawback of funding, or if you occupy a church school, there might be an estimate regarding the balance of your rights and obligations in respect of that building when it comes to determining whether or not they should be capitalized on your balance sheet. So with respect to going concern, which is one of these accounting policies, so as with the trustees report, the DFE is keen for trusts to ensure that where possible use of boilerplate text isn't utilised. So we really encourage in this section of the accounting policies trusts to think about the way that they assess their going concern as in the narrative side of things, and the level of disclosure within this accounting policy should again be sort of proportionate to the level of risk that you feel you're exposed to. So really the aim within this is to be as transparent as possible to ensure that the reader of the accounts gets the reassurance that they need that the responsibilities in respect of these areas have been considered. Now, we're coming on to the notes to the accounts next, which are covered on the next slide. So the first slide here is with respect to the income notes. So the income notes are notes 2 to 6 of the model accounts, or pages 39 to 41 of the model accounts document. And the first of these that we're within the model accounts is note 2, and that's a note on GAG and any restrictions on the carry forward of GAG. So that's only really relevant to you as a trust if you're on a very old funding formula or one of the older funding formulas. Most trusts these days are on a newer formula which won't have those restrictions on the carry forward. So if this doesn't apply to you as a trust, that's not necessarily the note 2, which is in the model accounts. But the snip on this slide really focuses on note 4. So this is the funding for the Academy Trust's charitable activities. So last year, additional subcategories were added below these headings within the model accounts to show greater detail, and the format of the note this year is really very similar to that. So in terms of key things to look out for this year, the areas worth mentioning are the treatment of business rates income, as well as the teaching schools disclosure. So firstly, in terms of business rates, so depending on your local authority, and this won't apply unilaterally, business rates may now be paid directly to local authorities by the ESFA rather than coming via the school. So from an accounting perspective, the trust still gets that benefit of those rates being paid. So a journal is needed to gross up your income and expenditure for that income and for that cost. So debiting your rates expenditure and crediting your ESFA income in relation to that income, or notional income rather. So to prepare for your year end in respect to that, you really just need to make sure that you've got details of the amount of benefit that you've received, so the amount of rates that have been paid on your behalf in order to form the required journal. The second area is just in respect of teaching schools. So one of the consequences of the move to teaching schools hubs is now there's fewer teaching schools, and as a result, a separate teaching school income and expenditure accounts requirement, which was previously at the back of the financial statements, has now been removed in this version of the Academy Accounts Direction. However, while removing that side of it, there's also a lot more detail now included in the Accounts Direction, which previously didn't exist. So this details that a teaching school hub is only one example that they're providing of potential activities. So this is shown at the bottom of this note here on the screen. So this teaching school hub is only one example of potential activities which may require disclosure, and trusts should also consider similar disclosure if they've got material income or expenditure relating to similar activities. So if, for example, you've got a skit, a maths hub, anything like that where there's similar activity, you may be required to split out in this note the values in relation to those activities if they are material. And just coming on to the next slide, it's also covered within the expenditure notes as well. So this expenditure notes are notes 7 to 11 of the model accounts, and this snip here focuses on note 7. So the expenditure within this, you'll see the expenditure for sort of teaching school hubs, and this is actually split now between direct costs and support costs. So one thing just to consider as part of the preparation for the accounts is apportioning any support costs that are necessary to that activities if it's estimated that those costs are material. So one way, for example, that you may be able to ascertain those is through looking at past Annex G returns to see the level of support costs that are being allocated, or potentially also looking at budgets and the apportionment of overheads within those. But it's just an additional consideration here. If you think there's a material apportionment of support costs required, there's that additional disclosure now. The bottom half of this slide really just indicates some of those additional required disclosures on costs mandated by various bits of legislation. So some of the key ones which are most commonly listed here, for example, any gains or losses on disposal of fixed assets, stock write-offs or bad debt expenses. So these all require separate disclosure here within the accounts. Moving on to the next slide. So this is a really important slide because of the level of scrutiny from the ESFA on pay levels and certain levels of termination payments at the moment. So the last year, the Accounts Direction this first update, the first bullet on the slide in relation to off-payroll arrangements. So just as a reminder, that requires any staff who are paid in ways other than through the payroll of the trust. So, for example, if they invoice for their services, for those costs also to be included within the staff cost disclosure. So if any of those individuals form part of key management, their pay should be included in, for example, the key management disclosure there. But then we'll just move on to 2 replacement disclosure requirements which have been added this year. So these relate to the way in which sort of severance payments are disclosed. So the first part of this disclosure is note 10B. So that's on your screen here, and this requirement is to show the number of all severance payments, sort of contractual, statutory and special, all combined together within the bandings that's disclosed here. So below 25,000, 25,000 to 50,000, 50,000 to 100,000, and then 100,000 to 150,000. So that's the first part of this new requirement. And then the second part of the requirement is to also list any special severance payments. So by special severance payments, the definition is any non-contractual payments for any of those special payments to be special severance payments to be listed individually. An example of that's provided in the model accounts here. So these disclosure requirements are a bit interesting because there's a bit of a myriad of Academy Trust handbook requirements when it comes to considering any severance payments. So firstly, I think it's 5.12 in the handbook. Academy Trusts must obtain ESFA approval when an exit package is made, which includes any special payment that is at or above £100,000, or a severance payments made to an employee earning over £150,000 a year. The second requirement they've got around that is for if an Academy Trust requiring a staff severance payment, which includes a non-statutory or non-contractual element of £50,000 or more gross before tax. Again, ESFA prior approvals required before any binding offers made to staff. And then the third requirement is any ex gratia payment of any value. So the DFE doesn't provide an explicit definition as to what they mean here in terms of ex gratia, but it could be taken to be meaning non-contractual payments. So any ex gratia payment would also require DfE approval in advance of a payment being made. And finally, if you're under a notice to improve, any special staff severance payment must also be agreed in advance. So just generally, I guess our steer on this is to try and avoid where possible or seek advance permission for any special payments to be made so that you're not exposing yourself to unnecessary scrutiny with regard to those payments. In terms of these staff cost disclosures, so the remaining key disclosures within this note are, as usual, the sort of key management personnel disclosure, the higher paid staff disclosure, and the trustee remuneration element, and there's no changes to those existing requirements. Moving now through to the next slide. So on this slide, we're skipping a bit to some of the later notes within the model accounts, and this one here is the related party note. So this is worth going to in a little bit of detail, since any transaction with related parties is considered material by nature for the purpose of reporting within the accounts. So when we're talking about related parties, we're talking about any transactions with another entity with whom an individual has significant control, who's got significant control of the Academy trusts. So that might be a member, a trustee, a member of senior management, and if they've also got control of another entity, they're considered to be a related party, and that also applies to close family members of those individuals. So any spouses, parents, or children of those, any transactions involving them should also be considered here. So some of the common transactions we might see, for example, are where family members are employed by the trust or a linked company provides services to the Academy Trust. So the requirements here of the handbook are to include within the financial statements, and there's examples here in the model accounts, a description of the relationship between the related parties, a description of the goods and services received, the total value of the transactions undertaken in the period, and also the balance owed to or from the related party at the year-end date. On top of that, the Academy Trust Handbook also has specific requirements in relation to related party transactions. So once the value of transactions exceeds £2,500, the trust must satisfy itself that the element in excess of £2,500 has been procured at cost. So there's this at cost requirement for transactions of that value. And then also for transactions relating to new contracts, which are in excess of £20,000, advance ESFA approval is also required before entering into any such transactions. So it's a requirement that the accounts specifically state in relation to these related party transactions that the Academy Trust Handbook requirements have been complied with in entering such transactions. Now, just coming through to the next slide, and this is actually the final slide. So this is a reminder of some of the other disclosures which impact particularly multi-academy trusts, and also some of the less common scenarios which we've seen having updates in recent years. So in terms of the multi-academy trust disclosures, so these are important to check because the mapping of some of these disclosures also has potential to impact the Academy accounts return submission data, and that in turn leads into some of the ESFA online benchmarking. So this impacts the year-end fund by school. The year-end fund by school is also required for disclosure for trusts that don't pool their GAG, and that helps users of the financial statements really just track the financial position of individual schools as well. So if schools end up having an accumulated net deficit on funds at the year end, an explanation is required within this note with regards to the trust plans to return the school to sustainability. And there's also a requirement for multi-academy trusts within the notes to the accounts to detail the services provided to individual schools, as well as the cost charged to each school by the central function. So these are different notes. There's various notes within the financial statements to which these relate, and they're all within the model accounts. But generally what we're seeing in terms of those recharges from between central functions and schools within trusts is that for more centralized multi-academy trusts, amount charged will generally be a higher proportion of the income of individual schools, because that is additional services that are provided by the central support function. So then just here in terms of the final point, so the final point to mention here is the PFI disclosure. So this is for a small minority of academies who may have buildings financed under a private finance initiative contract. So these contracts are typically between a local authority and a private company, and the Academy Trust won't necessarily be party to these contracts. So typically any buildings which are funded in such a way won't necessarily go on the Academy's balance sheet, but there'll be disclosures in the accounts to explain the arrangement, as well as the annual commitment the trust has under that arrangement to make the payments for. So over the past few years, there's been enhanced guidance in the Accounts Direction and Trust Handbook with respect to these PFI type arrangements, and the change this year is to provide some additional specific guidance with respect to the wording here and detailing the additional extra disclosure that's expected to be made. So really just a case of checking your existing disclosure if you do have a PFI arrangement within your trust, and ensuring these are updated as necessary just to comply with that latest guidance. But that's the sort of final area I had to go through with respect to the financial section of the account. So it's covered quite a bit, and I'm sure a recording will be available if there's anything to go back over, because we've gone through it quite quickly. But I'm just going to pass over back now to Kath to chair the Q&A. I'm not sure if we've got time for any questions.
Thanks very much, Matt. I think we've probably got time for a couple of questions. Matt, you've not had a chance to read these, so I'll take them. So the first one related to a trust, an Academy trust that has a sort of an external body. So in this case, an old foundation trust that holds the freehold of the land and buildings. And in some cases, that foundation is also appointing some of the members. So the question there is really twofold in terms of disclosures and narrative around that, but also in terms of the carrying value of the asset as well. So in terms of the disclosures around that, I think in the trustees report, you must be disclosing the relationship with the foundation, or it may be a diocese or another external body, in terms of the sort of the level of control or not there that foundation in this case has, the relationship and how you manage that. And then secondly, in terms of whether you bring the asset value onto your balance sheet as an Academy trust, if the external body holds the freehold, it really will be dependent on the scenarios. So if you have a long lease, then the Academy trust has that control over the asset. It has the sort of the benefits of ownership, the risks of ownership as well, and that's formally defined by that long lease over a significant period of time. So in that case, you would bring that the buildings, the property onto your books at evaluation. If, however, that external body has the freehold and you're only occupying that at will on a license that's much more short term in nature, and this is very much applicable to some of the church land and buildings disclosures as well, then often the property would not be on the trust's balance sheet, because you haven't got that sort of longer term control. And it is all around assessing the control over access, the control over works to the property as well. It's all set out in the Accounts Direction. I think it's section 3.23 that has the land and buildings accounting, and there are a few scenarios it gives there, but it's very specific to some of the church trusts as well, that they look at this in a lot of detail, and similarly if you have that foundation element. So probably best to be, in terms of the accounting, to be guided directly by the inclusion within the Accounts Direction. Just a final question that came through in terms of donated laptops. So the ESFA donated laptops for FSM pupils during COVID. The laptops weren't very good, so they were disposed of relatively quickly, each with a value of about £300. I mean, I think whether you bring those in as a sort of a donation, a donated asset or not, I think work out whether in total at £300 each times by the number of laptops you received, is that a material figure? If it is, I would just bring in the donated asset value in income and then have an equal and equivalent charge to expenditure. So you're not putting anything into your fixed assets, but you've got an in and out there to recognise that there was a donation, and you may want a little bit of narrative to go with that as well, possibly in the income, the sort of donations note that you include within the financial statements. But yes, definitely not to put something on the assets if they only had a very limited life. So that brings us really to the conclusion of today. Many thanks for attending. As we've said, the responses to the questions, the slides and the recording will all be circulated to all attendees. We've got part 2 of the workshop next Friday, so at 11 AM also, and that's around the preparation processes for the accounts, a workbook that we have, and also the preparation for audit as well. So really is the second part to what you've heard today, but hopefully you'll be able to attend that one as well. But many thanks for attending today. Thank you very much.